Hello students, let us start today's session. Today we are going to start a new topic which is mutual fund. Now this topic is covered in your section B. Section B has only one major practical concept which is mutual fund, which has lot of practical questions also in your CMA module. Now this mutual fund chapter is basically an origination from portfolio management chapter. A student, before starting mutual fund, you should know the portfolio chapter very well. If you have not studied portfolio chapter, then please do not study this mutual fund chapter. So before starting the mutual fund chapter, you have to finish your portfolio security analysis and portfolio management chapter, which is covered in section C. So while teaching mutual fund, I'm assuming you know everything: beta, standard deviation, risk, everything, covariance, correlation, you know everything. Then only you have to study the mutual fund. Okay. Now, what is mutual fund? In the mutual fund chapter, what all concepts will be covered? Now, in the mutual fund chapter, first thing that we have to cover is basically the framework of mutual fund. How a mutual fund is constructed, what are the roles of different parties involved. Then we have to, the most important topic on which every time the question will come, which is evaluation of mutual fund schemes. Then we have to do another very important concept, that is NAV per unit computation. NAV implies here net asset value computation we have to learn, and 2-3 more concepts are there. For example, expense ratio, and more 2-3 concepts are there which we will tackle when we will be doing the questions. Okay, so the most important concept of mutual fund is evaluation of mutual fund schemes, and then NAV computation per unit. So before going into that, let us talk about the framework of mutual fund. Okay, so how is a mutual fund constructed? Mutual, if you want to, suppose if you want to create a mutual fund. So mutual fund can only be created by a sponsor. Mutual fund can only be created by a sponsor. Who is a sponsor? Who creates a mutual fund? That organization is called sponsor. A sponsor should be a registered company. Registered company under Companies Act. So any company which is registered under Companies Act can open up a mutual fund. So the company which opens up a mutual fund is called sponsor. Now, is mutual fund which is opened is also a company? No. Mutual fund is not a company. Mutual fund is a trust, which is created under Trust Act. So basically, it is a trust. It is a trust which is created under Trust Act. Now, who operates this trust? This trust is operated by Board of Trustees. Board of Trustees are appointed, which manages the mutual fund trust. Now, what exactly is this purpose of this trust is? The purpose of this trust is that this mutual fund trust, people from the public as a whole, public invest their money, or I should say they give their money on trust. So they pool their money in this trust, public pool up their money in this trust. Then this money is not utilized by mutual fund. No, this money is transferred to a special organization which is called AMC. Now what is AMC? AMC is Asset Management Company. So what happens is that mutual fund collects money from public, and public gives their hard earned money on trust. Okay, and then this money, after when this whole money is pooled in, a corpus is created. A fund is created, and this fund is then transferred to AMC, Asset Management Company, which in turns invests this money in the securities. It can be invested in equity shares, it can be invested in debentures or government bonds. So this money is invested in the market as a whole. I can say this money is invested in the market, in the securities. Now, what is the role of different parties? See, one party is your public, who gives its hard earned money to AMC. No, it gives its hard money on the basis of trust to a trust, that is a mutual fund. Mutual fund itself is a trust which is created under Trust Act. Mutual fund is managed by Board of Trustees. Board of Trustees can sometimes be a company also, registered under Companies Act. When this money is collected, a fund is created, a corpus is created. This corpus or fund is then transferred to AMC for investment purpose. Now this money is invested in what? Is it invested in property? No. Is it invested in real estate? No. It is invested in securities, and some money is held as cash also. So liquidity is maintained. So this money is invested in securities in the market. It can be invested in the equity or preference or debt or government bond or hybrid. Nowadays, hybrid securities are also there in the market. It can be invested in that also. So now what happens is asset management company managed by whom? Asset management company is again a company. It's a company registered under Companies Act. Now this is managed by high profile portfolio managers. This is managed by high profile portfolio managers who charge very high fees. They are very experienced, very much qualified. So portfolio managers create a portfolio. See, let me write it on the next page. This AMC has lot of money, okay, from the public. Now AMC is basically managed by they employ portfolio managers. Now portfolio managers' duty is to create a portfolio of securities in which the public's money will be invested. They keep on changing the portfolio structure in order to get a good return. Now, ma'am, is this a very good portfolio? They claim that the portfolio created by them is best portfolio, is yielding high returns. Even it is the better portfolio than Sensex and Nifty. In the portfolio chapter, I have told you the perfect portfolio, or we can say best portfolio, is the portfolio created by SEBI, right? SEBI has created Sensex, SEBI has created Nifty 50, SEBI has created many portfolios. So these are claimed to be the best portfolios, but these managers say that the portfolio created by them are even giving better results than the portfolio created by SEBI. Basically, they are saying that their portfolio is better than the market portfolio. This Sensex Nifty 50 is called as market portfolio. So what happens is this claim has to be verified. We have to verify whether their portfolio, mutual fund portfolio, is actually better than the market portfolio, because market portfolio is a type of yardstick, or we can say it is a type of benchmark with which we have to compare that individual mutual fund portfolios are performing better than Sensex or Nifty, or they are performing less than Sensex or Nifty. See, as an investor, as a public, either I can create, suppose I want to invest my money, either I can create my own portfolio. I can invest my money in company A, company D, company C, depending upon my risk and return calculations, and I chose that I am going to invest my money in these 3 companies. This is my portfolio consisting of 3 companies. Now my portfolio can perform good or bad, both options are there. Since I am an amateur investor, so it is always suggested that if you are an amateur investor, you should invest in Sensex or Nifty, because this is a very good portfolio. it is rather assumed to be a perfect portfolio, which I have told you why we assume it to be perfect portfolio, because we assume unsystematic risk to be nil. If you remember, we have taught you this. So there is nil risk in this portfolio. But if you want to have more return, then you can, instead of investing in Sensex or Nifty 50 portfolio and other portfolios created by SEBI, you can go to the mutual fund. They will invest your money in their own portfolios, which they create by their highly educated portfolio managers. They create better portfolios than the market. But they claim this, that we are going to give you better returns than the Sensex or Nifty. So we have to verify their claim. Mutual fund portfolios are performing better than Sensex and Nifty. We have to verify their claim. How do we verify their claim? We have to evaluate mutual fund schemes or mutual fund portfolios. And how do we evaluate that they are performing better than the benchmark? We are going to evaluate. There are 5 different models that we can use to evaluate these mutual fund schemes. What are those models that we have to study? The first model is Sharpe model. Then there is Trainer model. Then there is Jensen's model. Then there is Morning Star model. Then there is also one more model, Fama's net selectivity model. These models are used to evaluate what, my dear students? Evaluate mutual fund schemes, or we can say mutual fund create various portfolios. Why am I using the word scheme? I'll just tell you in a second. So these are the evaluation models that is going to be my main topic of this lecture. But before starting the evaluation model, let us go to study some basics more. Now when a public, please understand, when a public invest, when public invest in a mutual fund. Now let us discuss the role of the public, the investor in this mutual fund thing. Now public, who is the investor? When an investor gives money to mutual fund, so whenever the investor is investing his money in mutual fund, is he lending money to mutual fund? Answer is no. He is not lending money to mutual fund. He is investing his money as a owner. He becomes the owner of the corpus that is created by mutual fund, or corpus here means the fund that is collected by mutual fund. He becomes the part owner of the fund that is created by mutual fund. Okay, so mutual fund, the trust, let us say trust creates a fund, collects the money from public. Now public is not giving any, public is not lending money, rather it is they becoming the part owner of this fund. Now how this part ownership is represented? Normally when you invest your money in a company, if you invest your money in the company and you are owner of the company, you are issued a shares in the company. Here the shares are not issued. Here units are issued. Units are issued. Now these units represents that you are part owner of the fund, and whatever the assets and liabilities are created from funds, assets will be purchased. Assets here means the money will be invested in securities. Why is fund created? Fund is collected because the portfolio managers are going to invest this money in the securities. So you become the part owner of the assets, as well as if any liabilities are also created, you become the owner of liabilities also. So you are responsible for gains and losses both, because you are the owner, you are not the lender. So you have the part ownership. And how this ownership is represented? It is represented by units. So mutual fund issues units to you, not shares. So when you invest your hard-earned money in the company, you get shares. But when you invest your hard-earned money in the mutual fund, you get units. Okay. So for example, suppose whole fund represents 10,000 units, and Mr. A has been, let us say, issued 100 units. Out of this 10,000 units, which represents the whole fund, 100 units have been issued to Mr. A. That means he has got 1% of the, I would say he's 1% owner of the fund. So he owns 1% of the assets and liabilities of the fund. Now that does that mean that when Mr. A, listen to this carefully, when Mr. A wants to exit from mutual fund, when Mr. A wants to withdraw his money from mutual fund, will his share of assets and liabilities will be sold out? Will his share of assets will be sold out for him? Answer is no. If an investor wants to withdraw his money, wants his money back, so his percentage share in the assets will not be sold. His percentage share in assets, in the case of Mr. A has 1% shareholding in the assets, and 1% he has the liabilities also. So will his 1% assets will be sold for him? No. If he wants his money, he can sell his units back to mutual fund, and mutual fund will redeem these units and give the money back to Mr. A. So this is how Mr. A can get his money after redeeming his mutual funds, or mutual fund units can be sold in the market also. Like shares can be sold, similarly units can also be sold in the stock market. So this is how you can redeem your share from the mutual fund, but you cannot ask them to sell the assets for you. But yes, this is correct that assets, you have a part ownership in the assets, you have the part ownership in the liabilities, and how much is the ownership you have? It is represented by the units. Value of units are computed every day. This value is called net asset value of units, which we have to learn how it is computed. Net asset value, which is very simple. In general, if I say whatever the fund's assets are, total assets on that particular date, on which date you are computing, as if today whole mutual fund is going to be wind up, then what is the assets value on that day less any liabilities divided by number of total units representing the funds, units issued to the investor. So you get net asset value per unit. With this rate, this is the rate, like share price is the rate, this is the rate of 1 unit. If you want to exit the mutual fund, then you have to sell your unit back to mutual fund or in the market, whatever is allowed, and then NAV per unit you will get the value accordingly as per NAV per unit. So you have to learn the net asset value per unit computation, which is very important. It has some important points that you have to notice, and also you have to learn the evaluation model. So first I'm going to start with evaluation model. Now the first concept that we are going to discuss is the evaluation model. Now in these models will help us to evaluate whether mutual fund is performing well or not. If public is investing its hard earned money in mutual fund portfolios, we very well know mutual fund creates portfolios for us, right? They create professional portfolios, professional managers are there, portfolio managers are there who create a wonderful portfolio. So mutual fund create portfolio. They invest your money in different types of securities, and the purpose of creating a portfolio is to reduce the risk and increase the return in comparison to risk. So purpose of portfolio is that only. Now mutual fund are creating various portfolios, so we have to evaluate whether this portfolio is performing well or not. For that, this evaluation models are to be used. Now how do you evaluate whether public money invested in a particular portfolio, let's say it's a scheme, portfolio scheme. So the public's money is invested in some portfolio, whether that portfolio is performing well or not, whether that investment is giving us good return or not, how do we decide that? Obviously, we have to compare the risk with return. Whatever the return we are getting, we should compare that with the risk. And risk can be classified in two ways. One is either you can say total risk. Total risk has two components, which is systematic risk and the other is unsystematic risk. Now, portfolio, after creating a portfolio, basically you are trying to diversify or eliminate or reduce the unsystematic risk. That is the main purpose of creating a portfolio. So, mutual fund are creating a good portfolio. Good portfolio means that your unsystematic risk should get reduced or eliminated. So, we are not going to talk about unsystematic risk. Whatever is left over is the systematic risk. Now, various models will consider risk and return relationship and then evaluate. So when I say the various models are going to consider risk and return relationship, here the risk will imply either total risk or it will imply systematic risk. So one model, the first model that I am going to start with, Sharpe model, when in that model, whenever I am going to say total, I am going to say risk, that implies total risk. In the second model, Traynor model, it is going to consider the risk as only the systematic risk. So risk meaning will change with the models. Okay. So first of all, one thing should be clear, that when we are evaluating a mutual fund scheme, basically it means we are evaluating the portfolio which is created by mutual fund, whether that portfolio is performing good or not. We are evaluating that. Now, how do we know whether the investment is performing good or not? Obviously, we have to compare the return we are getting and the risk we are bearing, right? So we have to compare. And secondly, we have to also compare this relationship with some benchmark or yardstick. So we are going to compare the mutual fund portfolio with a perfect portfolio, that is the stock market portfolios. I have already taught you in the portfolio chapter that a stock market portfolio is assumed to be a perfect portfolio, because we assume there is no unsystematic risk in it. So if the mutual fund portfolio is performing better than stock market portfolio, then definitely mutual fund portfolio is going good. But if mutual fund portfolio is not performing better than stock market portfolio, then why would people invest in mutual fund portfolio? They would invest in stock market portfolio. When I say stock market portfolio, I am talking about Nifty 50, one of the portfolio, then Sensex. These all are portfolios. Sensex, Nifty 50 is a composition of 50 companies' securities. Sensex is a composition of 30 securities. Similarly, there are many other portfolio which the SEBI has created, which we called market portfolios. So mutual fund should outperform the market. When I say market, I am talking about, this is a benchmark. Market here means the portfolio is created by SEBI. So there should be no confusion when I say whether the mutual fund portfolio has outperformed the market. I am saying whether the mutual fund portfolio has performed better than the stock market portfolios. Okay. So we are going to use various terminologies. First is risk, return, and benchmark. We are going to compare with the benchmark. Now let us start with the first evaluation model. Let us start with that. Now first evaluation model is your Sharpe model. Sharpe model. This model was created by William Sharpe. Okay. Now this model basically measures what? This model will measure what? This model will take, first it will take your mutual fund portfolio, whatever the mutual fund portfolio you are evaluating, performance you are evaluating, you have to measure, what you have to measure? Risk premium per unit of risk. And similarly, we are also going to compute the same thing for the benchmark, that is your market index. Market index means Sensex, Nifty. Example, let me write here. Whatever it is given in the question, like Nifty or Sensex, we are going to compare the same thing. We are going to compare what? Risk premium per unit of risk. Basically, it implies the formula is here is return from the portfolio minus return from the risk-free investment upon total risk of your portfolio. And here return from market minus RF upon the risk of market. Now Sharpe, I have not explained, I'm just explaining, I'm just writing here. Sharpe model considers the risk here in this in the Sharpe model, risk implies total risk. Now for example, let us take some figures, then I will explain you what the Sharpe model is trying to explain. Okay, so let us take one example, conceptual problem 1. And through that conceptual problem, I'll explain how a mutual fund portfolio is evaluated. Very simple, okay. So let us take conceptual problem 3. Conceptual problem 3 of your mutual fund. Yes. So if you consider the question, just see the figures, then I'll explain with the help of these figures what is this model is saying. Very simple model, very simple. Just have a look. FT's return. FT here means some mutual fund, okay, not the market, but some mutual fund. FT's return was 20% and that of the market as a whole is 15%. So market as a whole means Sensex, Nifty, they are giving, that portfolios are giving return how much? 15%, and your portfolio, mutual fund portfolio, FT basically here denotes the mutual fund. Mutual fund portfolio is giving return 20%. You must be very happy if somebody has invested in mutual fund, and market is only giving 15%. The standard deviation means total risk of the portfolio was 10%. And that of market is 5%. So the mutual fund portfolio has a risk of 10% standard deviation and market has only 5% risk. Market has less risk and market is giving you less return. Your portfolio here means mutual fund portfolio has high risk and it is giving high return. Okay. The risk-free rate of return is 6%. What is the Sharpe measure of FT portfolio? Sharpe measure of FT portfolio means what is the evaluation of the Sharpe for FT portfolio and comment on its performance. So let us solve this question using following figures. So what figures we have been given? See, if you talk about FT, right? So let me write here. If you talk about FT, what figures have been given? FT is giving you how much return? FT is giving you how much return? And this is your market. FT is giving you stock market, right? 20% return, and here you are getting only 15% return. This is called return from your portfolio and this is called return from market. Then what is the total risk? Total risk of portfolio given in the question is 10% and market is giving having a risk of 5%. And what is your RF? RF, risk-free rate of return, is 6%. Now let us do the evaluation first of, let us do the Sharpe's index. Basically evaluation. Index here means on one unit we are comparing. I'll explain. Now please tell me how much return, listen to this carefully, how much return the mutual fund gives you over and above risk-free rate. Without taking any risk, you are earning 6%. If you take risk, mutual fund is offering 20% return. So how much is the excess return over and above risk-free rate of return? So that is 20% minus 6%. This is your what? This is the return which you are getting over and above risk-free rate of return. This is called as risk premium. If you have studied portfolio, you know what is risk premium. Whatever you get extra over and above risk free for bearing the risk. So mutual fund is giving you 6% or more than 6%, more than 6%. How much mutual fund is giving you? 20%. So how much excess mutual fund is giving you? 14%. Why the hell mutual fund is giving you excess return? Because mutual fund has risk. So let us compare. If mutual fund gives you 14% excess return, let me write in a unitary method, okay? Let me write in a unitary method way. So for bearing, let's write like this. For bearing 10% risk, you are getting an additional return of 14%, right? Which is called risk premium. So for bearing 1% risk, how much return you are getting from this portfolio? Which is coming out to be 1.4. This is called Sharpe index. This is called Sharpe index. Why? What is this 14% divided by 1%? This 14% divided by 1% is basically nothing. You have subtracted from 20, you have subtracted 6%, then divided with 10%. Now what is this 20%? This is the return from your portfolio minus return from risk-free rate. This represents risk premium divided by total risk of the portfolio. So basically you are getting, what are you getting? What I have just written here. What you are computing? Risk premium per unit of risk. Basically we are computing. What is 1.4? 1.4 is the excess return you get for 1% of risk. Risk premium for 1% of risk. So if you see, this mutual fund is giving you 1.4% return, excess return over and above 6% for bearing 1% of risk. Now let us see how stock market portfolios are performing. Now stock market portfolio is giving a return of 15% and without taking any risk you earn 6%. So how much excess you are earning from the stock market? Stock market portfolios. Let us compute the first step. What are we going to compute? The risk premium. So 15% minus 6%. So you are getting 9% from here. Excess return. 9% you are getting because you are bearing a 5% of risk. So let me do it in a unitary method, that 5% risk you bear, you get 9% return. So if you bear 1% risk, how much excess return you get? So 9 divided by 5, so you get 1.8. Now what is this 1.8? This is the excess return you get over and above risk free for 1% risk. Now if you bear 1% risk in the mutual fund portfolio, you are only getting 1.4% excess return. And from stock market, you are getting 1.8% excess return. So obviously stock market is performing better in this example as compared to FT performance. So same thing we are going to write in our evaluation. Conclusion, simple one line conclusion. That is, FT has underperformed the market. Basically FT has underperformed and market has performed better. In simple words, let me write like this: market has performed better. Correct? Okay. So going back, so this is your conceptual problem 3. Now what do you have to memorize regarding evaluation of Sharpe model? First of all, when we are studying this model, basically what are we studying? We are studying how is mutual fund schemes perform, how the mutual fund portfolio is performing in which public are investing their money. Is that portfolio giving us good return? Comparing with the risk and also comparing with the benchmark. Okay, step 1. Now here in the first model, the risk here means total risk. Total risk is measured by standard deviation and systematic risk is measured by beta. We all know this. This total risk, let me write here. Total risk is measured by standard deviation and systematic risk is measured by beta. We have learned this in portfolio chapter. Unsystematic risk we should eliminate or reduce by creating a good portfolio. So we are not talking about the currently we are talking about Sharpe model. In this, risk means total risk. Okay, these are basically approaches. In the other approach, risk would mean different. Here the total risk means total risk, standard deviation. Now for mutual fund, you have to compare the Sharpe index. This is Sharpe index. This formula is Sharpe index. Ma'am, why is it called index? Why? Because you are computing what? Risk premium per unit of risk. How much you get excess for bearing 1% of risk. And for 1% of risk, whenever you compute for 1% one thing, that is called index. Okay. Similarly, you are doing for the benchmark stock market. Same thing you compute for stock market also. And then you see which portfolio, stock market portfolio or your mutual fund portfolio, which is giving you good return when you compare with the risk. So bearing 1% risk, which is offering you better returns. Okay, please write down the answer. Simple concept. I told you these evaluation models are very simple. So please write it down. Then we are going to do this next model. Pause the screen and write it down. Also write down this. Just a second. The first model, Sharpe model. Higher the Sharpe ratio, better it is. Let me write it here. Developed by William Sharpe. This model measures reward, or we can call it as risk premium, earned per unit of total risk premium is the return in excess of the risk-free rate of return, since risk under Sharpe model is total risk. It is computed as the standard deviation of rates of return. On the next page I am writing the higher the Sharpe ratio, the better is the performance. Pause the screen and write it down. Pause the screen and write it down. I am changing the page. Pause the screen and write it down. I am changing the page. So we have understood the Sharpe model. Now let us move on to the next model, model number 2. Now model 2 is basically again a very simple model, tenure model. This chapter is very easy. Okay, so tenure model. Now in the Sharpe model, whatever we have computed, same thing we are going to compute again in the tenure model. Only difference is that here the risk means only the systematic risk. Just systematic risk we are going to consider, because we already, if you have remembered, in the portfolio chapter we have taught you that the SML and the CML line, where the return can be compared with the total risk or return can be compared with the systematic risk. So we are now only considering which risk? The systematic risk, which cannot be, we cannot get away from it by creating a portfolio. Portfolio can only help in reducing the unsystematic risk, but the non-diversifiable risk, systematic risk, we cannot get away by creating a portfolio. It will still remain there. Okay. So going back, so in this tenure model, here the risk would mean the systematic risk, which is your non-diversifiable risk, that is, which cannot be diversified, which cannot be reduced, eliminated by creating a portfolio. It will remain there as such. Non-diversifiable risk. We have taught you a lot of things about the systematic and systematic risk, everything. Now, model 2, to understand, same thing we have to compute for the mutual fund portfolio. Mutual fund portfolio, and the same thing we have to compute for the stock market. What do we have to compute? We have to again compute the risk premium per unit of beta. Now, not the total risk, per unit of beta. And similarly, we have to compute the same thing for the risk premium for 1 unit of beta. Let us take one example and then see how this tenure model works. So let us do the conceptual question number 4. Please observe, we will use the figures of question number 4 and then I'll explain you how the tenure model works. Okay. So please observe question number 4. Now Shyam is a CIO of FT mutual fund. Okay, so there is a mutual fund and Shyam is a CIO. He found that his portfolio had earned a return of 20%. So basically, mutual fund portfolio has earned a return of 20% and has a beta of 1.2. What does the beta means? How much is your portfolio riskier in comparison to stock market portfolio? So your mutual fund portfolio is 1.2 times more riskier than your stock market portfolio. During the same period, stock market as a whole went up by 15%. So one thing, how much has your mutual fund portfolio earned return? 20%. How much stock market portfolio has earned? 15% return. What is the beta of the portfolio, mutual fund portfolio? 1.2. If the risk-free rate of return is 6%, compute the tenure measure for the portfolio and comment on the FT's performance. So with the given information, let us solve this question. Yes. So this is your conceptual problem 4. Now what all information has been given to us? FT mutual fund and then another information given for the stock market. Now let us write the first information, return. How much is the return given to us? Your mutual fund is making a return of 20% and the stock market has gone up to 15%. Beta is given. Beta is basically a measurement of risk here. 1.2 and stock market beta is how much? 1. And if you don't know it is 1, then please, that means your preparation is falling. It is not up to mark. Okay. And a risk-free rate of return is given to us how much? 6%. Now what do we have to do? We have to do what? First of all, let us find out risk premium. Risk premium is what? How much your mutual fund portfolio is giving you excess return over and above risk-free rate of return. So basically RP minus RF. How much is your mutual fund giving you return? 20%. And without taking any risk, how much return you can earn? 6%. So how much excess you are getting over and above 6%? 20% minus 6%, again it is coming out to be 14%. Similar thing I am going to compute for stock market also. Stock market is making how much? Stock market same thing. How much stock market is giving you excess beyond risk-free return? 15% minus 6%. So this is coming out to be how much? 9%. Then, so basically risk, how much excess returns you are getting. Why do you get excess return beyond 6%? Because there is a risk involved. This is the reward you are getting for bearing risk. How much is the risk in mutual fund portfolio? 1.2. And how much is the risk in stock market? 1 only. So let us find out the risk premium per unit of, you can write like this also, per unit of beta or non-diversifiable risk. So how much? 14%. If you want to understand, you can go like this also. For bearing 1.2 risk, you get excess return 14%. So for bearing 1 risk, how much return you are getting? So 14 divided by 1.2. So this is coming out to be 14 divided by 1.2. So you are getting 16.8. I hope I am not made any mistake. So you only computed 14 divided by 1.2. You are getting 11 point. Yes, 11.66%. Yes. So what have you computed? This is very important. This is very important. What have you computed? This is your Trenor's index. What does it mean? Basically, it implies that you are getting an excess return of 14% reward for bearing 1.2 beta risk. So for 1 beta, you are getting only 11.66% of reward risk premium. Okay. Similar thing we are going to compute here also. So here already beta is 1. So 9 divided by 1. Obviously it comes out to be 9. So here if you bear only 1 beta, you get 9% reward or risk premium. Here you are getting 11.66%. So both sides, the beta is 1 now, and how much return you are getting? Here you are getting 11.66 and here you are getting 9% risk premium. Obviously here we are getting more reward, more return for bearing 1 beta, and here for bearing 1 beta, 1 unit of non-diversifiable risk, we are getting 9% return. So obviously our mutual fund is outperformed the stock market. Our mutual fund has performed better. So in simple words, you can write like this also. Mutual fund FT has performed better than the market. Market here means stock market. Okay. So this is your conclusion. So basically what do you have to now finally memorize? The formula that you have to memorize is that is you have to compute what? RM. For mutual fund, if I talk about, for mutual fund, you have to compute RP minus RF upon beta of the portfolio. And for market, it is RP minus, RM, return from market, minus RF divided by beta of market, which is obviously 1. No need to say it many times. It is obvious. Beta of market is 1. Okay, then you have to compare who is giving you for 1 unit of non-diversifiable risk, who is offering you better returns. I hope this is clear. Please write it down. So this is the formula that you have used. Let me write the formula here. What formula have you used? RP minus RF upon beta of the portfolio. And here you have used RM minus RF upon the beta of the market, which is obviously 1. So please write it down, and I am writing some little notes on the your Trenor model. Trenor model basically is similar like Sharpe model. Here only risk we are considering only non-diversifiable risk, because we consider diversifiable risk would have been diversified by creating a portfolio. So for that excess return will not be offered. Excess return one should get because he is bearing risk. Which risk? Non-diversifiable risk. Systematic risk. What is systematic risk? This is risk which is at the macro level, which is affecting all the industries. Definitely in some proportion, some industries are affected more, in other proportion, some industries are affected less. But systematic risk affects all the industry in the same direction. That is called systematic risk. So please write down a little bit of notes. Yes. So Trenor model This was developed by Jack Trenor. This model measures the reward, that is risk premium, earned per unit of non-diversifiable risk under the Trenor model means only non-diversifiable and is hence the beta of the rates of return. Formula: RP minus RF upon beta of portfolio. Higher the Trenor ratio, the better is performance. Please write it down, pause the screen and write it down. Then we are going to move to the next model, which is the Jensen's model. Pause the screen and write it down. I'm changing the sheet. Pause the screen and write it down. I'm changing the sheet. Pause the screen and write it down. Pause the screen and write it down, please. I'm changing the sheet. Now, whether you discuss the Sharpe model or Trenor model, both the models are only talking about the ratios. Ratios, what do I mean by ratios? They are just only telling you the ratio. See, we are basically evaluating mutual fund, whether mutual fund has performed good or not. So, we are just finding out the ratio. This is ratio. Just a second. This is just a ratio that, and you are comparing the ratio, you have computed a ratio 11.66 and which you have compared with stock market. This is not, this 11.66 represents the risk premium you are earning for one unit of non-diversifiable risk. So if you bear 1% of non-diversifiable risk, you are going to get this much of reward. Okay, but none of the ratio. Even in this Sharpe model also, same thing you have learned. Here also you are getting 1.4. What is 1.4? This is for 1% of risk. So 1.4 divided by 1, 1.8 divided by 1. These are only ratios which are telling you if you bear 1% of risk, total risk, then you get this much of reward risk premium. But none of both the models have talked about how much return we are getting. I should say how they are not expressing in terms of returns. Let me tell you. None of the models have talked about how much mutual fund performance is not evaluated on the basis of return. Now in the next model, we are going to evaluate the performance of the mutual fund on the basis of absolute return percentage. See, in the previous models you were computing risk premium. Now nothing like that will be computed. Return, absolute return basis, it will be computed. Now next model is your Jensen's model. Now if you remember what is Jensen's alpha, if you remember, Jensen's word was used earlier also. There was a concept called alpha. Same concept is used here also. I told you alpha is of two types, but primarily it is Jensen's alpha. Now what is alpha? What is Jensen's alpha? This is Jensen's alpha model only. Now what is this model number 3? Very important, can be expected in exam. All models are very important, okay, because they are very simple. Objective questions can easily be asked from them. Now what is Jensen's model, or we can say alpha model? See, you remember CAPM model? Formula was what? We have done many questions. RF plus RM minus RF into beta of the portfolio. What does CAPM model basically used to compute? CAPM model used to say how much should be the return from your investment or from your portfolio. How much should be the return if you compare with the stock market. What does it mean? Suppose, let us say RF is, I'm just taking an example, RF is 6% and stock market is giving return 12%. I'm just revising it, okay. And the beta of your portfolio is 1.2 times. Now I want to know how much should be the return, how much should be the return that your portfolio should earn. Okay, CAPM denotes how much return should be earned when you compare yourself with stock market's performance. Okay, so see, stock market is giving you how much return? 12%. Without risk, how much you are earning? 6%. So basically stock market is giving you this much of excess return, 6%, which represents risk premium. Why is stock market giving you excess return? Because stock market has risk in it. One risk, stock market beta is 1, but your portfolio beta is how much? 1.2 times. So your portfolio should give this much of excess return. Excess return over and above risk-free return. So basically this should be the total return which should be given by your portfolio, your investment. So 6% plus 6 into 1.2, so it comes out to be 7.2. So 13.2% should be the return that your portfolio should give. Now if your portfolio is giving, let us say, 15% return, actual return your portfolio is giving 15%, and return which should come or which should actually be given should be 13.2, but you are getting 15%, then you are a happy man because you are getting more than what the company should offer. Be comparing with the stock market, performance, accordingly your portfolio should only earn 13.2%, but your stock portfolio is giving you 15% return. That means you are having a positive alpha. Remember what was alpha? Alpha means the excess return you earn over and above the mandated return of CAPM. All these words we have learned. Mandated return of CAPM. So if you are earning excess return beyond the mandated return of CAPM, that means you are a happy person. You are getting more than what even if you compare your portfolio with stock market, this is what you should get, and you are getting 15%. So you are getting excess return, which is coming out to be 1.8%. This is called Jensen's alpha. And if Jensen alpha is positive, it is higher, that means you have performed better than stock market, because according to stock market's performance, this is the excess return stock market is offering for 1 beta. Your company has 1.2 beta. So that means you should get this much excess return, your portfolio. Company portfolio means investment. And this is the basic return, risk return. So basically your portfolio should get 13.2% return if you compare with the benchmark stock market. And if your portfolio is giving you more return than the mandated return of CAPM, then if Jensen's alpha is positive and higher, that means your mutual funds investment is performing, or portfolio is performing better than the capital market. Okay, so this is how you do. So basically what you have to do under the Jensen's alpha evaluation model, simple, very simple model. First you have to compute what your portfolio, imagine what your mutual fund portfolio should earn, mandated return as per CAPM model, and then see in the question what is the actual return of your portfolio. Portfolio here means the mutual fund portfolio. Then if you are having alpha positive, Jensen's alpha positive, then that means your company, your portfolio has performed better than the stock market. Higher the alpha, and negative here means that your portfolio is not even offering what stock market is offering when you compare with stock market. So let us solve one question and see how this question, Jensen's alpha evaluation model is done. So let us observe one question. Question number 5. Yes. Question number 5, please observe. Compute the Jensen's measure of FT's performance. Jensen's measure of FT's performance using the data in concept problem number 4. So whatever the information was given in the concept problem 4, we have to do the mutual fund portfolio evaluation, but using the Jensen's model. What information was given? That your mutual fund was earning 20% return, beta was 1.2, and at the same time stock market was giving 15% return, risk-free rate of return is 6%. Same figures we are going to use. So let us solve question number 5. Yes. So conceptual problem 5. Yes, please observe. So what all information is given to us? Mutual fund actual return. Mutual fund portfolio actual return is how much? Mutual fund is giving us 20% return from portfolio, right? Return from market is 15%. Beta of portfolio is 1.2 times, and the risk-free rate of return is given to us 6%. First of all, let us find out Jensen's alpha. Directly we can find out. We have already studied in detail in portfolio chapter everything. So let us find out the mandated return as per CAPM model, which is, and then compare with the actual return of the portfolio. Actual return of portfolio is how much? Portfolio of mutual fund is offering 20% return. But let us find out the CAPM return. Now CAPM return formula is what? RF, let me write in bigger bracket, RF plus RM minus RF into beta of the portfolio. This is your CAPM model. So my dear students, 20% minus RF, risk-free rate of return is how much? 6%. Plus what is the return from the market? 15%. Risk-free rate of return is 6%. So this is the return which is we are getting excess from the stock market. So stock market is giving us how much excess return? 9%. But stock market has only 1 beta and our portfolio has 1.2 beta. So how much should our portfolio give excess return? 10.8. So basically our portfolio should give how much return? 16.8%, and we are getting how much return? 20% from our portfolio. Actual return we are getting 20%, and how much should we get when we compare with stock market performance? We should get 16.8 and we are getting 20%. So we are a happy person, happy investor. We are getting 3.2% excess return. This is termed as Jensen's alpha or Jensen's measure. That is how you measure the performance of the mutual fund schemes, portfolio schemes. Okay. So on the next page, we are going to write the same thing. Since the return, Jensen's alpha return is positive, FT's portfolio has outperformed the market or has performed better than market. I hope you have understood the very simple concept, very scoring concept. Please write it down. Yes, this is your third model, Jensen's, and let me write some notes on it. First you copy the explanation, then I'm going to write something on this. Let me write here. Yes, please write it down. Yes. Please write down both the Sharpe and Traynor models were ratios. They do not give us any indication of the excess return earned by the portfolio. The Jensen's models the return earned by the fund, which is in excess of that mandated by capital asset pricing model, that is CAPM. CAPM. Now J alpha here means actual return minus CAPM return, basically return of the portfolio minus RF plus RM minus RF into beta of the portfolio. Then higher the Jensen's alpha, the better is performance. If the alpha is positive, the fund has performed better than market. Please write it down. Pause the screen and write it down. I'm changing the sheet. Pause the screen and write it down. I'm changing the sheet. Pause the screen and write it down, please. So now we have done three main models. First is your Sharpe model. Then we have done Traynor model. Both were on the ratios, right? comparing with the benchmark. Then we have done Jensen's alpha, which talks about in the return, Jensen's alpha model. Now in the next lecture we are going to discuss the next two models, which is your morning star model and another is the pharma net selectivity model. So these two models we are going to discuss. They have a different approach as compared to these three models. These three models were risk and return they were talking about. They were talking about return and comparing it with the risk. So we were talking about how much reward we are going to get per unit of risk. That is what was discussed in these three models. But in this model, a different approach has been taken to evaluate the mutual fund scheme. So take a break, and in the next lecture we are going to discuss the Morningstar and Pharma net selectivity model. Okay, so have a good day. Thank you.